Good afternoon, and welcome to our second part of our four-part series on fiscal futures. We are happy to have you with us for another engaging conversation with a very distinguished panelist once again. Before I introduce them, though, I would like to do a little bit of housekeeping. Please ensure that you use the Q&A feature to ask your questions and participate. We are really interested in hearing all your questions, and we'll do our best to incorporate them into our conversation. Afterwards, you're also welcome to use the chat, but we encourage you to please use the Q&A feature instead. So without further ado, I'd like to please introduce this very esteemed guest of panelists. So first up, from last week, we have Xavier DeBrun, is the advisor at the National Bank of Belgium. He has 20 years of experience in fiscal affairs and research at the IMF, and has also participated significantly at Bruegel. Lucio Castro is an affiliate at Harvard Center for Economic Development. Previously, he held senior positions at the Inter-American Development Bank and the Ministry of Production in Argentina and Latin America's think tank, CIPPEC. Welcome.
Thank you.
We also have Professor Brian Kantor joining us today, Professor Emeritus at UCT. Welcome. He's also the Head of Research Institute at Investec Wealth and Investment, and prior to this served on government boards and commissions and was the Dean of the Faculty of Commerce at UCT. Welcome. We also have Tsepiso Mwakloli, how do I say your surname? Tsepiso Mwakloli, who is the Acting Deputy Director General of Assets and Liability Management at the National Treasury. Tsepiso has a deep interest in debt management and has a Master's in Economic Science as well as an MBA. Welcome.
Thank you.
Then also joining us, Mamokete Lijane, currently a fixed income sales trader and macro strategist at ABSA ICB. Prior to this, Mamokete worked as an investment strategist and fixed income analyst. She has a deep interest in the intersection between public policy, economics, and financial markets. Welcome. Also joining us once again is, from last week, is a familiar face, Ian Stuart. Welcome. Ian is currently on a research sabbatical from the National Treasury, where he was head of the Budget Office and the Fiscal Policy Unit. He is also a research fellow at Stellenbosch University and was a member of the IMF's Technical Advisory Panel on Public Finance Management. Then a new face today, Mr. Owen Wilcox, an economist currently working as a principal consultant for Oxford Policy Management, working in the public financial management portfolio. Before joining OPM, he worked at the National Treasury for 11 years in a number of roles, including economic forecasting, representing South Africa at the G20, and working in the public finance in the budget process. Last but not least, our dear ERSA fellow, Matthew Simmons, who we entrust with the facilitation of this wonderful panel. And yes, over to you.
Thank you very much, Margot. Yeah, this is a very interesting and I anticipate somewhat challenging panel, which I'm looking forward to seeing how the conversation develops in. But yeah, it's my privilege to be facilitating this, the second episode of the Fiscal Futures series for ERSA. This follows on the session 2 weeks ago on understanding fiscal sustainability in the post-COVID environment. And today we're going to be talking about financing the budget deficit post-COVID. I think there's a general consensus on the need for expansionary fiscal and monetary policy to support households and viable firms through the immediate downturn effects of the COVID crisis. But we entered the crisis with an already unsustainable fiscal position and a protracted deterioration in the economic environment. This begs the question, what happens next? I have a panel of 6 experts with us representing a broad range of ideas and experience, but they all share a passion for economic development and macroeconomic policy. Tsepiso is a 7th member. I've asked her here today specifically to provide an introduction or a contextualization of the issue from the perspective of the National Treasury. This, however, is not a National Treasury Roadshow event, and so she will be leaving the panel shortly after the presentation. As with last week, there's no scheduled Q&A, and just like last week, there is still no schedule at all. I will still be relying on the enthusiasm of the speakers to sustain the conversation, but we will value your comments or questions that you might want to post. They will not necessarily be answered directly, but we will do our best to incorporate them in the conversations. They will be seen, they will be read, and they will form part of the collective learning that is an outcome of the session. So please don't be shy. If you haven't done this before, you will see a chat feature somewhere on your screen. Use it and go wild. Chapiso, over to you.
Thank you very much, Matthew. Just going to put a few slides on. You should be able to see them now.
Yep.
All right, thank you so much. What I've done here is just to provide some context around the financing of the gross borrowing requirement. And I know you're looking at post-COVID, but I suppose it's quite relevant to also look at, you know, this financial year as well, leading into the medium term. And I'll give you an overview of what is required and how we think about financing what is required. And over and above that, some slides around the dynamics around asset under management and how we think about savings vis-a-vis what is available to finance the budget deficit. So this first slide, you would normally find it in chapter 7 of the budget review for those who follow the book. And what it does is that it shows us the gross borrowing requirement. The first line that you see is the main budget balance. So the main budget balance does not include redemptions. How we arrive at the gross borrowing requirement, then we add the redemptions for that particular year, and it gives us the total that is required. You'd notice a huge number on 2021 relative to budget February 2020, that number has increased by 344 to about 776.9 billion. I want to put this number in perspective. If you look at prior years beyond 2019-20, the average financing requirement, gross financing requirement of government used to average about 250, 260 billion rand. So the huge jump in a very short period of time to 776 or 777, it is quite massive in relation to what, one, we've been funding, and secondly, what we would like to fund and what the market is capable of absorbing. And if you look beyond, I mean, it's still averaging about 560 with the scenario, active scenario that we've shown in the supplementary budget. I still think that those quantums are still quite sizable, and we would need to then do much more to deal with how we finance the budget deficit. If we look in terms of now the financing, this financing is underpinned by mainly the benchmarks, or what we call guidelines. I'll show you in the second slide, in terms of dictating how much goes to where. So the domestic short-term loans would mainly be your treasury bills from 3 months to 12 months. The domestic long-term loans would consist of retail bonds, inflation-linked bonds, and also the fixed-rate bonds. Then we have the foreign loans, which most of these are marketable debt. Very little of non-marketable debt, i.e. your bilateral agreements and MDBs until this year. And just to show you the change that we had to respond to deal with the domestic capital market pressures, we've had to increase treasury bills quite substantially. You'll see that at the time of the budget, we're looking at a net issuance of about 48 billion. We've now revised it to about 146 billion rands, which is quite massive. The domestic long term, we have not tempered with that much because already we understood the strain that was already in the bond space. So a bit of increase, but not as much. Then you would see another feature there that is different in terms of the financing strategy. Foreign loans, we're about to, looking at about 29 billion rands. We've gone to about 125, and that is in dollar terms, it's equivalent to about $7 billion US. On average, under normal circumstances, if we are not pre-funding or not trying to catch up, that number is usually around 2 billion or 3 billion in any given year. Last year, we raised about $5 billion US, and that was on the back of the fact that we were behind the previous year. We could not raise anything in the markets because we had quite a volatile market then, and the pricing was not great. So that is a huge difference that you see. Another difference is that the foreign loans in the past were being used to finance foreign currency commitments. What we've done now, given the high rand requirement, we've obtained those funds and are converting them into rand to be able to then fund the local currency expenditure requirements, which is something we had to do in this instance to give a breather to the domestic capital markets. Over and above that, something that we would do as well is we would use our cash balances, we would run them down, build them up, run them down. You would see that at the time of the budget, we were looking at using about 17.7. Now we are using about 43.2, and depending on how the other instruments perform, we might even use more. So what we've been having, if you've looked at our cash balances previously, there has been operational cash balances, sterilization deposits, and also the foreign currency deposits. Foreign currency deposits at any given point in time would average about $8 billion US. When we are not using those funds, they count towards reserves. Otherwise, we would then use them for smoothing our cash requirements, especially if the markets are not great and we don't have to go and borrow at all cost. The sterilization one, we've used it temporarily over month end, also as cash management, and we would then put it back. These are amounts that were built up during the time where Treasury was running some surplus, and it was used to assist the SARB to build some reserves. And now that we are in a very difficult situation, we've had to also use a substantial amount to cushion the requirement on the domestic sources of funding. So that also has to come through. There's about 67 billion rands. We anticipate that this year we might use anything between 40 and 50 billion rands. Obviously, there are risks to revenue, especially coming through in October. So to the extent that there are shortfalls, we'll have to then adjust and revise this funding strategy. And the other features of the strategy is we've also started to issue quite short, even on the long-term loans. I know our short is not very short. Every country would tell you that we've got the longest average term to maturity compared to no other country, especially in our peer space. But we've had to move inwards, and obviously moving inwards and issuing a substantial amount of treasury bills means that it creates a level of refinancing risks that we need to be cognizant of. In the immediate, which is this financial year, we'll do whatever we can, obviously, to deal with those risks. But going forward, what it suggests is that it's not sustainable to be able to continuously rely on issuing short-dated bonds. Very good in terms of cost, but also very risky given that we have not actually been able to redeem quite substantial amounts of our redemption. These amounts used to average the 64.7, 67.2 used to average around 80 billion. The reason they are lower is because we conduct switch auctions that helps us to exchange shorter dated debt for longer dated debt. It has its own challenges. It's voluntary. It's a voluntary program. it can distort the curve in terms of the pricing, and we've seen an elevated yield curve, which I will show later as well. But the elevated yield curve obviously is as a function of the credit risk that is embedded in our funding instruments, given the ratings that we currently have, the volume of debt, and also market variables do have an impact on how our curve would look like. But the biggest driver really is the volume of debt that we push through at any given point in time. I spend a little bit of time here because this is almost the anchor of everything else that comes through. What then comes through also is just to give, when you're looking at the big numbers, you don't know what they translate into. But just to give you a sense on this slide is the fact that as of the supplementary budget, on a weekly basis, we're raising almost about 24 billion rands. If you want to contextualize it in a monthly basis, it's almost about just over 90 billion rands. That is quite a substantial amount of money that goes through the treasury and the accounts and the market. Obviously, there are risks in terms of this market funding, as I had indicated. Uncertainty, volatility, liquidity in the market plays a big role, and that's why with the drying up of liquidity, SARB had to come on board and assist in terms of ensuring that there is ease of trading and the spreads are very much compressed in relation to where they used to be. The next slide, so this focus on the market funding, the next slide now starts to deal with the MDBs, which are multilateral development banks. We've talked about them. People have been quite interested in the financing thereof, about $7 billion US. Most of these funds are once off. For example, the $4.2 billion US from IMF, it's certainly not going to be available every year. It is responding to COVID. And while we are able to access this at very favorable terms, we are quite cognizant that beyond, dealing with COVID directly, we might not be able to have access to this amount. There's still portions. I mean, they do projects and budget support or policy-based kind of funding, which we can still access. But I must say that it is not going to be a 7 billion. Currently, just to give you a sense, we have raised about 5.5 billion of this 7 billion. AFDB about 300 million US dollars, about 5 billion rands, and NDB about $1 billion US dollars, and then the IMF at 4.2 billion. So that makes the 5.5. The remaining bank is the World Bank, where we are still engaging in terms of the requirements that they have. Theirs is not necessarily, it is COVID, but it's more a policy-based instrument. So it is not as easy to negotiate as the other ones, which were really focused on COVID and COVID programs. So this is a new space. We most likely continue to tap to the extent that we are able to do that. I think we should, obviously bearing in mind whatever conditions that might be required as part of that support. Other sources that we've looked at Islamic bonds in the past. We've even issued one in the international capital market, which has redeemed even. We are now looking at issuing the Islamic local bond. The team are working very hard to. But my approach is that whether it's an Islamic bond, a green bond, a social impact bond, a solidarity bond, a bond is a bond and is a bond. It works the same. These ones are even a bit tricky because they are not having economies of scale. There's niche markets, they've got small volumes, shorter maturities. Most of them have complex compliance and reporting. And having done the Islamic bonds previously, it also shows that they are not particularly cheap relative to conventional securities. So as we consider other sources of funding, we do have to consider some of the pros and cons in evaluating whether it is the right tool to use. Project funding, also not a perfect fit for our South African budgeting framework. The way the monies flow, they would go all of them into the National Revenue Fund. There's no ring fencing of monies or project. But with a focus on infrastructure, I think this type of funding might come in handy, especially when you get funder oversight and you also get technical assistance in relation to the project. And given our rate of implementation of projects in South Africa, I think very much needed to have several layers of oversight to ensure successful implementation of project. We are piloting the project funding with one of the MDBs, and we'll see how it works. And I think if once it works well and we can see the outcome of it, it will be then easier to start finding ways and obviously the framework that then supports this project funding to make sure that the much needed infrastructure is then delivered. This is also slide funding strategy underpinned by risk guidelines. So whatever portions we put at the top in the first slide I showed is essentially being informed by these benchmarks. They are not written in stone. We do follow them, but like this year where we've had to issue more in other instruments than we would have under normal circumstances shows the agility that is embedded in these benchmarks. They've been developed with the help of the World Bank, and they've finished 5 years. They've been reviewed again for another 5 years, and it gives you a sense of, where do we feel comfortable with what, whether you're looking at short-term debt, long-term foreign, and the kind of weighted term to maturity that we it's not even a target, because in most of these, you would want to see different numbers, but it was as a portfolio at the time when these numbers were developed. They do provide a very important guideline in terms of how we think about the risk embedded in each instrument. And this, although everybody has seen, it's just showing the evolution of the ratings downgrades, which they do impact on the cost of borrowing, whether we like it or not. And it shows at any given point in time what was happening. The interesting slide, if I can gloss over very quickly on this one, is this one that shows the debt service cost. I mean, when the rating agencies were, the ratings were improving, you could see the correlation with the debt service cost, and it's sort of, when we were just about stagnant and then we start deteriorating, you can see the upward tick also in the debt service cost. So it's important that we also pay attention to that. The cost obviously has increased quite significantly for government. If you look at where we were trading in terms of these bonds, where they were at the time of, let's say, January, and you compare the orange line here to the blue line and the yellow line, you can see that there has been a deterioration in terms of the yield curve. Obviously, your long end would be much more pronounced, because investors would then want to be compensated quite handsomely for the risk, especially in this uncertain environment. So these two are for the local currency bonds in terms of the fixed rate and inflation linked. The bond auctions, I must say, even if we track our week on week funding, are well subscribed. And as I said, we've concentrated issuance on the short end. We are also cognizant of the refinancing risk, and we can do it for this year. We might not be able to sustain it going forward. The bond switch program, I've also alluded to it, which helps us manage the redemptions, because currently we are running a budget deficit, the primary deficit and the main, suggesting that we're not even making enough money to cover our own debt, which is a problem. So more and more we are at the mercy of lenders to take from Paul to give to Peter. And this is the reality that we appreciate from where we sit. And sometimes you get a sense that everyone does not appreciate where we are. On top of that, these are the foreign loan yield curve. It also has a similar kind of trend. If you compare the gray line to the other lines, obviously there has been some kind of compression in the yields, which is good. It's coming back to pre-COVID-19 and rating agency level, but we don't think that it would get any better than that. But that's the picture. People ask, why are you saying IMF loans are cheap? I mean, if I have to price a 30-year loan or even a 5-year loan today, you're looking at anything between 7% and 9%. IMF 5-year loan is coming at 1.1%, for instance. So it does show you how cheap relative to the market these funds are. But as I said, the MDB funds are not forever. So at some point, we'll have to come back to the market, and hopefully we've made progress in terms of our reforms and also showing seriousness in containing the budget deficit. In that way, then we're able to still access this market at reasonable rates that do not put a lot of pressure on the debt service cost, which is already one of the fastest growing expenditure line item, crowding out much needed spending in other government policy imperatives. So very important to keep track of that. That's the debt service cost. I've got a graph and also a table just to contextualize the numbers. But as you can see, I mean, these numbers are growing quite significantly. As a percentage of revenue. For every R1, 21 cents is spent on servicing debt. And I've already alluded to the drivers: market variables, inflation, interest rate. But the biggest driver, honestly speaking, it is the quantum of debt that is piled up, that is driving this number, which is expected to continue to grow given our credit quality. This I've shown earlier, just the correlation between the debt service cost. This is as a percentage of revenue. And you can see that this direction is not a very good direction. And there's certainly a perceived probability of default, which we end up paying for one way or the other in terms of the premium that is embedded. The bottom graph really just gives you a sense of the growth in debt that has constantly the orange line outstripping the growth in the economy. Not sustainable. What we're not saying is we're not saying debt is bad and we should not be leveraged. There should be a certain level of leverage, but at the same time, you should be able to guard your ability to pay. So if you are running, growth levels as we see here, it means you're never going to be able to then service your debt, which is a challenge and something that we need to guard against. Another interesting graph here, we've plotted the budget deficit with the gross savings for the country, about 14%, 14.5%. You can see that for the past few years or so, it's been ticking up, but it's been reasonably within what the country is able to save. For the first time this year, you can see the gray bar is going over the gross savings rate or amount bar, which does point to a constrained market, and it does point to the challenges. The internal gross savings, 14% or so per annum. And even then, this amount is still split across different asset classes. It doesn't suggest that all of it would go to financing the budget deficit. The asset under management, which obviously is informed by the savings, you can see how various assets are sitting. With 15.9 trillion asset under management, sometimes people think it's the money that is sitting under mattress. I always say the money is already deployed, it's working in the economy, and there are limits to what can be held in what. So while we are talking 15.5 trillion, not all of it is going to be financing the government budget deficit. And actually, the new money that's coming through, it is very small relative to what is required to fund the deficit. Asisa was looking at about 100 billion that is coming into the fixed income space, which still needs to be shared across entities and also government. With this time as well, you've got risks around the withdrawal of provident funds and pension funds, and also the growth of these assets under management, certainly not as fast as the growth in the gross borrowing requirement. This is a picture that I think, as we make arguments for what should be happening and what needs to be done, we need to bear in mind and appreciate. Another risk is the fact that for a while we have supplemented our low internal savings with external savings, mainly from the non-residents. And you can see just with the red bar graph there, the trend is going down, which means that the external savings are reducing as non-residents continue to reduce their holdings of government bonds. This is a real risk in the context of a very low saving rate country, when you are not able to attract the external savings as we have previously we've enjoyed. I mean, we've reached highs of over 40% in terms of these holdings. Not only have they been able to finance the deficit, but what they've also done is allowed us to be able to fund at a lower rate because of the aggressiveness that we've seen at the auction point. So one area that we need to look, obviously, South Africa is among other EMs that are struggling. And if you look at the trends, whether it's bonds, whether it's equity, on the EM space, the trajectory shows some kind of impact that is not positive, that is negative. And obviously some EMs will be impacted more depending on their specific idiosyncratic factors that are at play. But we are saying, we do agree it's not just a South African problem, but also South Africa has its own problems that are quite distinct to us that we need to consider when we make certain policy choices. Also found this quite interesting. If you look at the peers in terms of where the public debt is vis-a-vis budget deficit, you can see where South Africa is in relation to these numbers, almost sitting out as an outlier. Well, most of these countries are bunching up at a certain point, looking at lower budget deficit and in some instances even lower debt. And you can see the EM average in the black dot there. Also, this picture should tell us that maybe we do need to reflect and introspect in relation to the direction that we want to take. I'm about to conclude. I asked Matthew for 30 minutes. This is the last slide, really just summarizing why SA cannot continue to keep increasing its borrowing requirement without safeguarding its ability to pay. And if there's any takeaway, is the fact that the gross saving rate is very low and cannot sustain the level of spending and investment. It is there, it's structural, it's been like that for a while. The growth in the gross borrowing requirement certainly outstrips the growth rate of asset under management. International investors have sold off a significant amount of SA government debt, thereby reducing external savings that we very much need. The growth in national government debt is crowding out other investment, which could result in job creation and increased revenue. Growth in debt has constantly been outstripping the growth in the economy. We've touched on that. The rising public debt means that an ever-increasing share of tax revenue is transferred to lenders. In our case, the majority of lenders are bondholders, so that's why we've put a proxy for that. Debt service costs are also crowding out service delivery, resulting in less money being available, for instance, to be spent on health and education. And the last point is that government, where we are right now, is not generating enough revenue to repay accumulated debt. So more borrowing is done to repay debt and interest, and this can create a vicious cycle that could lead to a sovereign debt crisis that Minister of Finance have alluded to, and we've also alluded to in the various conversations that we've had. So thank you very much, Matthew. I look forward to the outcome of the discussions of the panelists, and to the extent that we can enhance our debt management or strategies that we look at. If we have not considered anything, certainly welcome conversations in that regard. But At this point, let me thank you and the panelists for the opportunity. Thank you very much.
Chipisa, thank you very much for agreeing to come through and do that for us. I think that, you know, when we were discussing this, I was very clear that I didn't want this to be a opportunity for people to engage you directly or specifically on the details of the financing strategy. What I really wanted was a conversation about what this means economically, given that this is a fairly unique challenge that we face, certainly not a financing pressure that we've experienced before in the democratic environment. And so, yeah, I asked you to come along and just kind of sketch out what those numbers look like so that our conversation is properly contextualized by facts. And I'm looking forward to hearing what this diverse range of, let's call them experts, think about how we go about dealing with this at a macroeconomic level and limiting the costs and creating opportunities for development. So thank you very much. You've served what we discussed excellently, and you are welcome to leave as a participant, and it would be great if you joined us back as an attendee to hear what it is that we all have to say. I'm gonna...
Thank you very much. I've worked for my dinner. Have a good day. Yes.
Cheers, thanks.
Cheers, bye.
I'm gonna pass this on to Xavier. I mean, Xavier, you and Lucio are the non-South Africans on the panel, and you've got a lot of experience working with countries at a fiscal level, evaluating debt sustainability, identifying risks, and how countries should best be relating to that. I want to ask you what your observations are of South Africa based on what you saw in Chipiso's presentation.
Well, Matthew, thank you so much. I mean, it's obviously very different from the South Africa I used to work on when I was at the IMF in 2003, 2005. This was obviously a very different context, and debt was going down and risks were low. And today it seems that if we look at the fan chart of public debt for South Africa, not only the trend is going back up, but the fan has actually widened substantially. What struck me most in the presentation was this one of the slides showing that actually the government's borrowing needs are actually greater than national savings. I mean, this is very shocking, because it means that you really, I mean, if you want to, like most countries, you know, enable what I like to call a congruent policy mix, that is a mix of monetary and fiscal policies that are fully supportive to economic activity, to buffer this enormous and unprecedented shock that we're facing. You must rely on foreign loans. You must find a way to tap on foreign savings. And it looks right now that, you know, given when I look at, you know, the ratings and probabilities of default for whatever they're worth, but anyway, they're there and they're significant. It is absolutely critical to think about how to bridge this current situation and the huge needs of fiscal support with, in the medium term, a return to credibility. Obviously, there are doubts right now about long-term credibility of the government's commitment to fiscal sustainability. And you're facing a short-term emergency. So to me, it looks really like a no-brainer to actually fully exploit the opportunities offered by official support, be it from the IMF and the World Bank. And my understanding is that the two institutions always go together. So you can't access World Bank money if you don't have an IMF program, an IMF supported program. And I think that to me it looks pretty clear that this is the strategy to follow. Of course, I'm thinking aloud. As you said, we did not prepare anything or anything like that. I was not even expecting that particular question. But since you asked, it's, you know, based on the presentation, it strikes me as being, of course, I must be wrong, but because we are there to brainstorm, but it strikes me first as a no-brainer to have this two-pronged strategy where first you engage with international financial institution, agree on a plan that is expected to bring you back to markets at investment grades ASAP, thanks to a bunch of reforms, which I think, you know, the nature of those reforms should be well known. Probably there are political obstacles like everywhere else, including in my country, Belgium. But I think this looks like an unavoidable or the only way forward, which is to have this two-pronged approach. First, you know, avoid any kind of liquidity issue by seeking support from international lenders. And second, you know, make sure that you put in place quickly as a reform strategy that will allow you to recommit or, you know, reacquire from the markets the credibility that is currently today at risk. So I mean, again, you know, thinking aloud, I wouldn't waste any time not to go to Washington, but at least to have extensive video conferences with Washington.
Xavier, we've known each other and worked together for quite a long time, and I've always known you to be exact, polite, sometimes diplomatic, but you never really mess around with introducing issues. You always go straight to the heart of it. So I guess the introductions are over. Xavier takes us straight to the heart of the matter. We are looking, I often read the analysis of our fiscal situation and the financing requirements associated with it. And I'm personally often struck by the lack of alarm around what it means. And I think that Chapiso's slide about the size of the financing requirement relative to our savings is one of those indicators that really kind of should be driving the message home. Are we overreacting? Is it just a kind of a pressure point that needs to be dealt with and got through? Or is it indicative of some kind of crunch that we are facing that potentially looks like a fiscal or maybe even an economic financing crisis? I'm going to ask the panelists to start putting up hands, but who would like to come in on that first? Brian, great.
Yes, well, Xavier spoke about a bridge, and I think that's the issue. We have to find a way to bridge the gap between the current state of the economy, which is dire, and has fiscal consequences. And most of the deficit, growth in the deficit is not coming from government spending, it's coming from lack of revenue. So it's the revenue line that's really deteriorated hugely. So we need a bridge. And I think we need the imagination to deal with both. It's quite clear, and I don't think it's at all controversial in any way. And the Minister of Finance has been helpful in this regard, and indicating just how dire the structure of South African finance, government finance is. And the reasons for that are as obvious to all. I mean, we just spend too much relative to what we can collect. The tax rates themselves probably have a disincentive effect on growth and undermine revenue. And it's a path we've been on since those glory years, 2003 to 2008, when the economy did 5% a year growth. But what happened to government spending over those years, over those manual years? It exploded. And where was the money spent? On employment benefits for government officials. So unless we can address those and the spending, we have no stability to offer in the long run. However, and yeah, where I think the imagination is needed, we do issue a fiat currency, and that gives you opportunities, it gives you options. There's no such thing as default risk, unless you have huge amounts of foreign debt. It's not debt owed to foreigners. Repayable in dollars is debt owed to foreigners. 30% or so may have come down a bit, but repayable in rands. So the foreigners are taking on the rand risk. They're taking on the inflation risk. They're taking on, I think in particular, the exchange rate risk. And yeah, it struck me very forcibly is the disconnect. On the one hand, inflationary expectations remain subdued and declining. And interest rates have been high. And why are they so high if inflation expectations decline? Because in fact, the carry is so high. So the reason we have very high interest rates is because the rand's expected to depreciate consistently over the next 10 years at around 10% a year, 9% a year. And that makes our long-term debt extraordinarily expensive, and there's a whole lot more of it now. Not hopefully forever, but now. And you've got to try and deal with that. And the way you deal with that as a sovereign nation and with the right to issue your own currency, you deal with it with money creation. In other words, your central bank, as central banks are doing everywhere, without reluctance and knowingly, central banks take on the job of debt management. And the spread, I mean, as you mentioned, the spread between short and long-term interest rates means that if you borrow for 10 years, you pay an extra 5.6% a year for 10-year money over 3 months. And that's just too expensive. So you do two things, and this is what I've been arguing for. You let the central bank fund much more of the government expenditure and the deficit, both directly and by accommodating the banks to buy more of the long-term, the short-term stock. And you do that knowingly, and you're doing it as a temporary measure. And everybody understands why it has to be done and why it is temporary and why you have to solve the long-term problem. If you can't solve the long-term problem, well, you can't get anywhere. In which case you do run into your debt trap. And but it doesn't follow axiomatically that to fund more of your spending, enough of it with money creation is inappropriate. It is quite appropriate. But our Reserve Bank, unfortunately, has adamantly, sort of rhetorically, not necessarily in action, but more in rhetoric, refused that approach, or deny the usefulness of such an approach. And I should add, incidentally, that additionally, that money creation is useful in stimulating spending, which is again why it's being done everywhere. So you need a plan to recover as much in South Africa as anywhere else from the lockdown, and we've had a particularly severe lockdown. And money creation, adding to the money base, hopefully adding to bank credit, is a stimulus to the economy. And as soon as, and in addition, it's all agreed, and it's in the bond market, that the inflation outlook has not deteriorated. In fact, it's improved. So to talk inflation targets at a time like this, I think, is to miss the point about helping a recovery. And as soon as the recovery materializes in a consistent way, which won't be soon, and as soon as inflation might pick up again, then you reverse course, which is again the same charge on the developed world. So I'm distressed by the lack of imagination and sound thinking. The bridge between a current crisis, a huge output gap, no inflation pressure, yes, a weak exchange rate, which in itself is a help to the recovery, and something I think we should hope to maintain. An undervalued, deeply undervalued currency as a stimulus to output. That's something to be welcomed, especially when inflation is not rising and won't rise. So we need more spending, and the one program that was promising in this regard was the default bank loan default guarantees offered by the Reserve Bank to the banking system, which has failed completely. So potential 200 billion of loans to help businesses, essentially, I would say, recapitalize so that they can get started, so that they would want to start up again. We've had
Thanks, Brian. Can I intervene? I mean, there's a lot.
I've been making these arguments. Just my final point. I read very closely the speech of the governor to Wits Government School on 18th of June. It is not sound monetary economics what he is arguing. I can demonstrate that, but we don't have the time. He's not on top of the game about money supply, money creation, about sterilization. I mean, you want to create money, you don't want to sterilize it at this stage. Anyway, one final point. In July, the money base did grow. It had not grown at all since January to June. In July, it grew by 8%. Whether that was intentional or not, but certainly it was in itself helpful. Right.
Thank you. Thank you very much, Brian. There is a lot for us to chew on, and I think there's going to be that is very helpful in giving us something to hook into and talk about a bit further. Owen, you had your hand up next, but I actually want to go straight to Mamokete and then come back to you. I think that, I
agree with most of what Brian said, so it's fine.
That's what I'm thinking. So rather, let's give you an opportunity to disagree with Mamokete rather than just agree with Brian. Mamokete?
Hi, good afternoon, everybody. So I'm not going to talk about the SARB up front. I think just like to speak a little bit about the whole financing equation and constraints and abilities around that. So I think what we need to first realize is that the funding issue is a liquidity story. So to the extent that you can access the liquidity that you need to service your liabilities, you're okay, right? But that is influenced by quite a number of things, some of which are in your control and some of which are outside your control. So within your control is things like policy credibility, the deficit, debt, etc. And then on the other side, you've got the market environment. And we witnessed already in March what happens when the market environment changes dramatically, and how quickly things can blow up and rates can go up, and how quickly access to capital can dry up. So that is one of the things that one needs to consider, is what is happening in the external environment. So to the extent that you can influence what you can, you create a little bit of room for yourself to fund. But I think we need to acknowledge that at the moment, one of the reasons South Africa is able to fund is because the global environment is enabling. So then if you look at who the actual funders are, I think it's one of the questions that you'd put up, Matthew. So for 2020, you've got the IMF loan, so we can park that. But under normal conditions, you have short-term debt, long-term debt, and foreign debt. Within the short-term debt, for instance, a lot of that is funded by the banks. And this year, Tsepiso showed the numbers, that number has been bumped up quite aggressively. And then you've got the long-term debt, which is the one that you would really want to fund in, and that's your long-term domestic currency debt. And part of that has been funded by offshore investors and some of it by domestic investors. So let's say in theory, it's half-half, right? And you need those participants to continue to come into the market for the fiscals to continue to be funded. And I think this is where I think somebody like Brian, when you say South Africa is essentially issues a fiat currency and foreign investors are the ones that are taking the currency risk because they're borrowed in local currency. What we need to acknowledge is that they can choose not to. So they're taking the risk because they choose to take the risk. If that risk becomes unduly large, they can choose not to take the risk. If you look at the numbers that Tsepiso put up, at the moment, foreign investors hold somewhere like 30% of domestic bonds, which is a really large number. We saw what happened in March when they exited and sold about 50 billion of those bonds over a very short period of time. So if you build a risk that the rand can depreciate aggressively somewhere in the system, they will dump bonds again. And that money is going to flow out and you will not be able to fund the fiscus. And I also think we need to think about the fact that you're not just looking at funding the fiscus. This is a whole economy problem. So if you are unable to access funding from foreign investors because they're currency considerations, that is going to affect the entire economy. If foreigners are not putting money in this economy because of our low savings rates, you're not going to get investment, you're not going to get growth. So what you are going to be doing in that environment is just pushing the economy into another recession. So it's not clear to me that one can look at the investor mix as it currently stands and say, well, foreigners are going to continue to buy this market, because they won't. And if you look at other economies that have run into debt-induced low growth environments, it's really been driven primarily by the buildup of government debt. And as a consequence of that, a sudden stop in flows, whether you're talking, you're issuing in rand or you're issuing in dollars, really doesn't really make a difference. You end up at the same place. You can no longer access savings and you can no longer grow. So that's my contribution.
Thank you, Mamokete. I'm going to hand over to Owen for his contribution. Before that, I just want to draw attention to the panelists, but also the attendees, to the Q&A. There are a couple of interesting questions coming out of that I think are very relevant, some of which we've touched on, but we might want to think about how we integrate some of those points going forward. There's a question about, as you've been discussing, Mamokete, the role of foreign investment in our financing mix and the risk of losing the confidence of that investor base. There's a question about the importance of a growth-led fiscal consolidation and stimulating the economy through an investment program that will generate additional GDP and tax revenue, which would contribute to the deflator swelling. And then someone called Chairman Powell spraying liquidity in the global economy. I think that might be a reference to the opportunity that we have under advanced market quantitative easing, and maybe not so much an opportunity because it seems to bail us out whenever we make bad decisions. But certainly we need to be thinking about how that informs foreign investment choices in our domestic bond market. Owen, over to you.
Thanks, Matthew. I want to caution against this narrative that we are on the cusp of a fiscal crisis. I don't I don't really see that. I think if you look at debt markets, the long-term yields are quite high. We did see almost exactly the same thing in 2008. Matthew, I'm sure you remember when you were head of the budget office, that there was panic in markets when the global crisis struck. There was panic, and we saw massive outflows of currency. And it was purely what it was panic. And once markets recovered, and once the panic subsided, obviously, QE came in, as you said, and we ended up getting massive inflows of currency. And so we saw long-term yields going from about 8% pre-crisis up to about 12% during that peak of the panic. And a few months later, our 10-year bonds were yielding 6% because we had such massive inflows of foreign currency. And I'd be surprised if we don't see the same thing again, frankly, because a number of reasons. There is the scope of QE that's been carried out in advanced economies is much larger this time. Secondly, there's interest rates in advanced economies are lower. I think the number is something like 98% of advanced economy debt is yielding less than 1%. At some stage, once panic has subsided, investors are going to be looking for yield. And when they see South African debt yielding 9% and a currency that's weak, that looks like a good bet. And I think the other thing I've looked at as well is, what sort of debt levels are a problem. We saw this explosion in Lebanon recently, and they disclosed that Lebanon pushed their debt to GDP up to 170% of GDP. And of that 170%, 60% of that was dollar denominated. I'm not trying to say we need to push up our debt to that level at all. I'm just saying, if we think that we're running out of space, we could take actions that are going to be very costly for this economy. And I'm thinking particularly of the consolidation that's planned next year. That's going to be extremely costly. It's going to lead to much higher levels of unemployment, poverty, hunger, and to boot, it's probably going to result in higher debt to GDP because it's going to reduce our GDP. So I think, obviously the long-term picture is not positive. We need to get control of our debt to GDP problem. The way to do that is to fix growth. And ultimately it's a growth problem that we need to solve, not a fiscal problem. And I would agree with Brian 100%. QE is a tool on the table. I don't know, you don't send an army into battle without its tanks. So why would we leave that? If we've got that tool, we should absolutely be using it.
Thank you. I mean, I think that bridges a little with the next conversation, but I think we should certainly allow ourselves to reflect on it a little bit in this environment, which is the role of the budget in supporting the economic recovery. It did come up in the previous session too, and my discomfort with that is we've been selling this story of a growth-led fiscal consolidation led through a reorientation of spending towards investment for over 10 years. And that story has been financed, as you pointed out, by quantitative easing. And what have we bought with that? It looks like we've bought a lot of debt, a lot of interest costs. We don't seem to have built many assets. The governance environment seems to have deteriorated. The implementation environment seems to have deteriorated. So I think that, that to me is a challenge that government needs to step up to. But the historical pattern of the last 10 years has been one of less than appropriate delivery of that. And in the absence of those reforms, where do we find ourselves? If I'm going to throw myself out of the window, I want to know I'm going to survive the fall. So if we're going to go into a extended period of very accommodative monetary policy to support an investment program by government, I want to know that the other reforms are taking place that are going to result in that kind of stimulus turning into an increase in investments on the supply side of the economy, and not just blowing out through aggregate demand into leakages, higher current account deficits, and inflation. Let me see. Ian Stuart wants to, no one's actually being paid, so I can't actually say that he wants to earn his place here, but you're being paid in opportunity and power, Ian. Please take it. Please go ahead and take advantage.
Okay, thank you. Well, Matthew, thanks. I want to just go back though to the discussion on financing, which was, of course, the main argument. And I think I came into this discussion, I think, more sanguine about our ability to finance. Although looking at those numbers from Tsepiso, it's really extraordinary. And if one thinks of sustainability as partly, one's relative to position in the rest of the world compared to other emerging markets, it's extraordinary how large the expected increase in debt is over the next 3 years. So that actually makes me more concerned. But I tend to agree with Owen's point that there is so much liquidity. And especially if we were, say, to allow our yields to rise somewhat, we should, at least in the short term, together with support from the IMF and World Bank, cover our financing requirement. But I want to talk about the other element, which is the idea that the central bank should get involved, and perhaps QE, I don't know what we want to call it, QE or bond buying program. And there's even a debate about whether or not we are practicing QE. So I'd be interested to hear from the panel what they think about that. But I think there's generally an idea that the only cost to using central bank financing of the deficit is higher inflation, and that we're a long way from higher inflation. So there isn't a cost until that point is reached. And that I don't agree with, because I think that once you start using the central bank to finance government spending, first of all, you are using up a stock of credibility, which may be intangible, but is hugely important. So this idea that somehow the distinctions between the central bank and the government, it's just a balance sheet, it's all one balance sheet, you don't need to think about these things too closely, I don't agree with at all. If you think about it as a risk return or a cost benefit analysis weighted by risk, then central bank financing is extremely risky. That's the reason why, precisely why we have these distinctions. So you are using up something. It's your stock of credibility. Then second of all, you do generate inflation, but you seem to generate asset price inflation, which is what we've seen globally. And I don't have a strong view on this. I'm not a monetary specialist, but it seems to me that asset bubbles have been a major cause of instability in the past. So it's not clear to me that the fact that we don't see CPI inflation, but other forms of inflation, means that it's costless. I'm not sure about that either. And then lastly, of course, the act of this is basically, QE is basically generating bank reserves and generating more reserves than perhaps the banking sector needs. And I would think that that creates distortions in portfolio decisions. But again, this is not, I've been focusing on fiscal, so I'm almost putting it to the panel to see if they agree with these points. But for me, it always comes back to the credibility of it. And we seem to actually be quite close here, because we're saying we need a credible medium to long-term fiscal plan, which reins in the wage bill and so on. But that we need a bridging finance program to get us there. And my concern is, if the size of the debt is now so large that even if you take and assume relatively large fiscal multipliers, the arithmetic just becomes very difficult. It's very difficult to see how you get to a situation in which additional borrowing actually gets us to a lower long-term debt to GDP ratio, which is the claim. And so, when one takes that all into account, I think of it more as this is probabilistic by definition. We're all trying to work out what has the highest chance of working. And I think those other costs need to be taken into account. Thanks.
Thank you very much. Yeah. Lucio, I want to hand it to you. I mean, you've got a particular experience both in the work that you've done, but also in the country where you were born and trained. And I would like to just ask you to reflect on the conversation so far, and how you are hearing it, things that we need to perhaps recognize but aren't recognizing, challenges that we might be being a little blasé or relaxed about. Let me hand it over to you.
Thank you, Matthew. I would say to start that the presentation from the Treasury was sobering because it shows the extent of South Africa's fiscal conundrum from an international perspective. The second thing I would like to stress is that experts in each country believe their problems are unique and their causes are country-specific. South Africa has two valuable assets in the emerging markets: low inflation and a deep financial system. Yet, if anything, the experience of Latin America and other emerging markets points out that the laws of gravity ultimately apply to public finances. High and persistent fiscal deficits ultimately led to unsustainable debt levels and high inflation, and eventually could lead to debt defaults and major macroeconomic crises. The fundamental problem is government expenditures not financed by regular source of revenue, meaning taxes. South Africa do not want to lose the credibility of your fiscal policy and your currency. No country has ever become developed by losing credibility and debasing the currency. From the revenue perspective, and more broadly, from a financing perspective, South Africa displays high levels of tax revenues to GDP, higher than the emerging markets average. Also, it shows a jump in tax revenues to GDP in the last 10 years. There is no room for further tax raises in a recessionary economy and a low growth environment in the post-COVID period. And also, as the presentation from the National Treasury was extremely clear to show, you are experiencing increasing difficulties to tap local and external savings. So the fundamental question is, and I think that the whole panel has been revolving around this question, is what to do to finance government expenditures. So in the previous webinar, my colleague Miguel Brown mentioned a project led by Tim Fijoy and Juan Pablo Nicolini at the Minneapolis Reserve Bank that distills some lessons on the contemporary fiscal and monetary history of Latin America. So what can we learn? What South Africa can learn from the recent Latin American experience since the 1960s? First of all, is that you should avoid the temptation to cut down debt through confiscation of assets denominated in local currency, that it is through inflation of prescribed assets by financial institutions. While this experience might seem remote to South Africa, the history of Latin America teaches that fiscal policy credibility and monetary credibility can be rapidly eroded and lastly destroyed. For instance, in Argentina, my own country, until the mid-1970s, large and increasing fiscal imbalances were met majorly through the issuance of domestic debt in local currency, very similar to the situation in South Africa. Yet, the local debt market was destroyed by a burst in inflation and a massive depreciation in the exchange rate at that time. That was the outset of an increasing dependence of the fiscus on external debt, the original theme, and sustained and persistent portfolio realization of both firms and households. The second lesson is that you must avoid resorting to other distortionary sources of revenue, such as taxes on financial transactions or export taxes, among others. The more distortionary the tax structure, the lower the economy's growth potential, given the detrimental impacts of taxation on resource allocation and the overall efficiency of the economy. The final lesson is that countries like Chile that were able to sustain fiscal discipline were able to achieve consistent and stable rates of growth, while countries that lack fiscal discipline, like my own country, Argentina, suffer recurrent economic crisis, stagnation, and decay. I would like to conclude, Matthew, my remarks with a comment on quantitative easing. Some Latin American countries and other emerging markets are making use of QE only as a temporary and emergency measure in face of the pandemic. But it must be noted that these countries are countries with ample fiscal space, which does not seem to be the case of South Africa, which means moderate levels of public debt and or low fiscal balances and real interest rates close to zero prior to COVID, like the cases of Chile and Colombia. And very closely to what Ian was saying before, the region's experience, the experience of Latin America suggests that once you let the genie of inflationary financing of the treasury out of the bottle, it is very difficult to resist the temptation of continuing confiscating local currency denominating assets, whether we are talking about debt or money. QE can be a useful instrument in face of a large output gap, like the one we are facing right now in most of the countries due to the pandemic, but requires having ample fiscal space and maintaining credibility in monetary policy. Blurring the lines between the central bank and the treasury can be a one-way road to fiscal unsustainability and nominal unsustainability. So, from my experience and my perspective, what South Africa needs is to reduce expenditure and stimulate growth by undertaking reforms. Growth requires investment, and investment can only be boosted in a stable and non-distortionary macroeconomic environment. Thanks.
Thank you, Lucio. There's a lot there that was very important that I think we need to take account of and reflect on. I mean, one of the thoughts that came to mind as you were talking is, I wonder if it's a South African peculiarity, but maybe it's something that is shared across the world. The idea of investment-led growth somehow is the responsibility of the government. And investment stimulus is somehow about government delivering on investment stimulus. But, you know, I wonder if there's a need for us to broaden the idea of that to take much greater account of the private sector and the role of the private sector in generating income growth. Xavier, you've got your hand up. I've got a hand from Owen and from Mamokete. This is looking fun. Go ahead, Xavier.
Okay. No, just to, I wasn't planning to start with that, but just to reflect on what you just said, Matthew. I mean, yeah, I know of no fiscal expansion that pays for itself. That just doesn't exist. And be it investment-led or whatever. And yes, we see everywhere, including in my own country, a natural tendency of people to think that somehow, if you don't have enough investment, it's because the government is not doing it. And, you know, you have people here in this country arguing that, you know, the green investment boost that we need actually is entirely in the hands of the government, while we know full well it is not true. The government has nothing to do with electricity generation. The government has nothing to do with other green-related issues. So it's about the tax system and other things. It's not about public investment. But that's to close the bracket. I just would like to come back to you know, a bunch of arguments I've heard. First of all, yes, it's true that when we face a shock like the COVID shock, which is again unprecedented, you really want to have a full blast policy mix that is one that is that use both legs, both cylinders of the engine to actually stimulate the economy. And this is an emergency, and this is well understood. And what is very nice in that kind of situation is that when you have a sort of congruent policy mix, that is both monetary and fiscal policy are trying to be stimulative, they sort of create space for each other. If monetary policy is expansionary, it lowers the borrowing cost for the government and it creates space for fiscal policy to expand. And there is also another underappreciated role that monetary policy can play, still within the usual framework of independent central banks, is for the central bank to provide what I would call a monetary backstop for government bonds. In other words, the central bank can actually, and have the means, at least if most of your debt is denominated in a domestic currency, it has the means to actually rule out bad equilibria. So it can protect you from market people going a little bit crazy. And I think that this is an important way in which a central bank, still within the framework of an independent inflation targeter and so on and so forth, can actually provide important support for fiscal policy. I've heard about quantitative easing. I would like to perhaps clarify that to me, quantitative easing essentially means an unconventional policy instrument, which is simply meant to expand the reach of monetary policy beyond the usual short-term refinancing rate for financial intermediaries. So typically QE has been used in countries that were constrained in terms of their conventional instruments. I mean, the COVID obviously opens the possibility to also use QE in combination with more conventional instruments, and that is certainly something that is interesting to observe. However, I would like to make the link now as a segue to to the financing of the government, and this sort of idea that seemed to be floating, at least as a ghost idea, that somehow there is something magical about monetary policy and money and budget financing. I mean, the kind of stuff you read or you hear from modern monetary theory people, which is neither modern nor a theory, by the way. So hang on, I mean, QE, yes, it's about injecting liquidity and let the markets adjust different interest rates along the yield curve to see what the outcome is. However, there is the flip side of QE, which is in my view much more dangerous, and which is in fact what I think some people have in mind, which is called yield curve control. Yield curve control, it's a bit like QE, except that instead of targeting the quantity of easing that you do, you actually want to target the price, and potentially you finance whatever is needed, or you buy whatever assets, whatever quantity of assets is needed to actually get to a certain yield curve that you like and that will help the Treasury finance itself. That is a case of explicit coordination between the Treasury and the central bank, and that is a regime change. That is not what you will usually see in an environment where the central bank is truly independent and focused on guaranteeing macroeconomic stability, which implies also price stability. So that's dangerous, because regime change means that if you think your inflation expectations are anchored, perhaps that suddenly they would become unanchored. And you might actually experience the kind of evils that countries like Argentina, actually, since it was mentioned, experience, which is a complete loss of credibility. You don't have credibility of the fiscal side, and through yield curve control, you actually allow the lack of credibility on the fiscal side to metastasize like a cancer to the monetary side. And that's where you lose things. And, if you look back at history, we had very clear episodes of yield curve control. One of them is the United States in the late 40s, early 50s. There was yield curve control. So the Fed was actively buying treasury bills to get to a certain result in terms of yield curve so that the Treasury could finance itself at conditions that were favorable. And this was nice in the late 40s and also the early 50s, because President Truman could claim that there was an emergency, and the emergency was the Korean War. And there were fights, epic fights between the Fed and the administration about when are we going to end this YCC, this yield curve control? Because in the meantime, inflation was creeping up to basically double-digit numbers. And it took a massive conflict between the administration and the Fed, which ultimately the Fed won, to actually end yield curve control. But that was only after the US was on the verge of losing the nominal anchor. So, and we're talking about the US. So when we're talking about, an emerging market economy, which seems to be losing its fiscal anchor or its fiscal credibility, I'm quite uncomfortable personally hearing arguments about quantitative easing that to me sounds like yield curve control. Because if we go there, again, this is regime change, and this is exactly when you lose your credibility.
Thank you, Xavier. Owen, you got your hand up next.
Thanks, Matthew. Look, I think we need to look at the context of this, and that, that this is not, we are not the only country in the world that's contemplating this. It's being carried out in every single advanced economy. There's 17 emerging market economies that are using QE at the moment. We're probably the largest economy that's not actually using QE.
Can I ask you, I mean, 17 economies using this, a whole host of emerging economies using this. When I look at the reporting of what emerging economies are doing, I'm not sure that they are doing QE. They seem to be protecting market stability. Their interventions, their stated interventions, are very similar to our stated interventions. Perhaps they've implemented more of that statement than we have. But also the countries that seem to have done quite a lot of intervention, those countries, their interest rates pre-intervention were close to zero, let's say functionally zero. So I'm wondering if that global comparison justifies such a response in our environment.
Well, I think there's a range of what those economies have done. So when you're talking about the 17, yeah. So there are, some have done not so much, but you look at Poland, they've got up to 4% of GDP. We're at less than 1%.
Does it matter that Poland's interest rate was 1% when they started that?
It doesn't in this context because we have such a huge output gap. That's the key issue, is that the output gap is so large that we can carry out QE. We don't have to really worry about inflation for now. And as you know, this is a temporary measure. I think there is this concern about whether politicians get a taste for QE, right? And whether it's something that we can't roll back. What I'm suggesting is a temporary measure. It's only a temporary measure, and it's because we have such a huge output gap. It's because we saw that 3 million more people are unemployed, 1 million people are getting pushed into hunger. That's the solution to that. And I worry about what government has actually done. We spoke about a 500 billion rand stimulus, but it's actually turned out to be probably 36 billion rand. So I think what I'm saying is that we need a stronger counter-cyclical response, and QE is part of that. And I don't think we stand out in terms of when every other economy is doing it. Well, not every other economy, but many other economies are doing it. I don't see how we would lose credibility relative to everybody else. Credibility is a relative concept. So it's, if everybody else is doing it, why can't we?
Okay. Thank you, Owen. Mamokete, I mean, we're, you know, time flies when you're having fun. So it's now 4:30, half an hour left. Mamokete?
Oh, that went fast. So I'm just gonna just agree with a few points that have been made around policy credibility, both monetary and fiscal, and the fact that we've got like, I don't think fiscal credibility is actually that high, but we've got quite a bit of monetary policy credibility, and we need to spend that wisely. So I'm just gonna park that because I think it's already been spoken to. Then the other thing, the way I'd characterize the current situation, we're caught in a negative feedback loop. So basically, it's a death spiral that's going quite slowly. But with each incremental decision that we make, we're either going to make it faster or we're going to slow it down. And in fact, what you need is you need a spoke that's going to stop the whole negative thing from spiraling out of control. Losing monetary policy credibility wouldn't achieve that objective. So I'd worry a bit about that. So what do I mean? I mean, at the moment, you've got a situation where we've got really high funding needs. In order to satisfy those funding needs, we have had to issue shorter, increasing our portfolio risk. So the things that we say make the debt portfolio more defensive are the things that we're eroding. So we're quickly eroding those things. We've got more offshore loans. We've got shorter dated loans. So we're increasing our refinancing risk. So come next year, the situation is worse. So you need to do something to stop that negative spiral. So incrementally, that's what we need to be looking at doing, not trying to make the situation worse. And the other thing that I'd like to address is this issue that you've had 2008 and things were really bad, but it was externally imposed, etc. As I started, I said, this is a function of what is happening externally and what is happening internally. You cannot ignore that the situation in South Africa now, the fundamentals are dramatically worse than what they were in 2008. So you might have an enabling global environment, but we know that that kind of thing unwinds. So before you even hit COVID, you had a situation where you're growing at zero. Your long-term growth potential was somewhere in the region of 1%. And even that was questionable because every time you grew above zero, you ran out of power, which is actually telling you probably potential growth was somewhere around the region of zero, right? So you leave COVID. Other emerging markets are looking at growth potentials in the region of, let's say, 5%. South Africa is looking at growth potential in the region of zero. That has got nothing to do with COVID, right? So whatever debt you build up now, you have to ask yourself how you're going to pay for it over time, because that speaks to the debt affordability. And that also speaks to the rate at which you're going to accumulate debt. And then when you look at where the bond curve is right now, it is not true to say that South Africa is responding in the same way as other emerging markets. It is not. We've got just about the steepest curve amongst the large emerging markets at the moment. The curve is telling you that there's something really stinky about this environment. So you ignore that at your peril. And to say that, okay, the way to fix that is to get the SARB to pull the curve down. All you're doing is you're undoing the only lever of credibility that you maybe have in the system. That is going to make it even less likely that you're going to be able to fund yourself. And all it's going to do is accelerate the descent. So you are already in a negative spiral. I struggle to see how you can argue otherwise. And what you need to be doing now is to try and stop it and try and avoid solutions that look simple on the face of it, but would probably accelerate your descent.
Thank you very much, Mamokete. Brian, you had your hand up next.
Thank you. Listening to the conversation, as I said earlier, we have long-term issues. If we're only going to grow, we're not going to grow at all over the next 10 years or so, well, we're in even bigger trouble than I think we're in. But presumably there are things you could do to promote growth. I could think of any number. In fact, I wrote a book about that, Get South Africa Growing. But one has to, and I think Owen put it in context, and the context is all important. We are in a crisis. We are facing, enduring a collapse in economic activity. Output gap is enormous. I don't think we know quite how big it is, but I think it's going to be a bit bigger than the Reserve Bank thinks it can be. And logic, economic logic says you try and do something to close that output gap. I mean, surely that's not an argument. I mean, that's the sensible thing to do. And you don't have to be a Keynesian to know that if you can increase demand and output simultaneously, that does cost you nothing. In fact, you're moving out towards the edge of the production function, as we used to teach. So it is costless, and you can fund it costlessly by printing money. Now, the argument is that destroys your reputation, and the only credibility we have is this Reserve Bank that's such a dogged inflation fighter and wants to maintain its reputation almost at all costs to the economy. Even when it is well aware that inflation and its own forecasts, as good as they may be, suggests there'll be no inflation. And the bond market tells you there's going to be no inflation. So to me, you've got to try and separate the requirements of the economy in the short term from the long-term structural reforms that we all agree on. And incidentally, the savings issue is even more serious than you think it is, because almost all of the savings, gross savings, are made by corporations, which are then reinvested by them. So we lack savings, we need foreign capital, we need to attract foreign capital on good terms, but nothing will. Now, let me make this point about the reputation of the Reserve Bank. It has a reputation for sound money, for independence. I think it's hidden behind that reputation and adopted perhaps policies were too onerous for the state of the, be that as it may, it has a reputation. That reputation could be used to defend a policy of temporary relief, which will end as soon as inflation rears its ugly head. Surely, such an argument of the kind I've made could be made credibly and should be made credibly. It's a counsel of despair to say you can't do the right thing because in fact it might be misinterpreted. It does not have to be misinterpreted. It can be properly explained, and it hasn't been. And if you look at the bond market and that spread, it doesn't suggest that the Reserve Bank is getting it right. I mean, if the Reserve Bank were admired for its reluctance to use quantitative easing, surely the long bond yield would not be where they are, though you could argue that it could be worse. Well, to me, the reputation is not being well used in the interests of balanced and sustainable growth, which is the constitutional charge. Incidentally, on money creation, there will be money creation, the Reserve Bank likes it or not. The 42 billion that the Treasury are going to use out of its deposits with the central bank, which were accumulated years ago and are being run down, will add to the money base. That's money creation. And that will be useful. And it might well be that the money supply in South Africa grows at something like 10 to 12% a year over the next while, which will be helpful to the purpose. But it might well make the Reserve Bank look a little ridiculous if that is the case, despite all their protestations otherwise. So, counsel of despair we could avoid. Do the right thing, provide the right arguments for doing the right thing, and attend to the long-term structural issues. And I agree entirely, we are dependent on foreign savings, and the better we grow our economy, the more attractive we will be to foreign savings. And how do we grow our economy? It's going to take more than fiscal consolidation. It's going to take a whole lot more than that. And it's going to take also an improved capacity of our extraordinarily well-paid government service.
Thank you, Brian. I want to use the last 20 minutes to give each of you an opportunity to make a last statement. Let's target 3 minutes for that. I will start sending you messages through the chat as that approaches. And I'd like to start with Lucio and then end with Xavier. I don't know who I'll put in between. I'll figure that out a little later. But as Lucio thinks about what he wants to say, you know, there's an interesting kind of some sort of consensus in what is being said. I think that the idea that in the short term, fiscal and monetary policy need to be going full throttle and doing absolutely everything they can is understood. The divergence is happening over the medium term. And I wonder if the reason for that is because, yes, you need to go full throttle in the short term, but you need to maintain credibility. So what does full throttle actually mean? It doesn't mean just opening the throttle. It means there's a limit to how fast you can go. And that limit is the point at which your medium-term institutional framework starts to dismantle. That is made further complicated by the fact that the fiscal institution, the credibility of the fiscal institution has deteriorated significantly, which is placing all of this responsibility and burden on the kind of cashing in the credibility of the monetary institution. The basic ideas that we're talking about, I think, are pretty much shared. The issue is, where are those limits? So let me hand over to Lucio.
Thank you, Matt. I think that credibility is an extremely fragile good. And the experience of Latin America is that many countries in the region, they went for the inflationary road in face of a massive macroeconomic external shock that was the 1930s Great Depression. Many of the countries in the region, they thought, well, it might not be a bad idea to push the limits of monetary policy to compensate for the limits that we are facing in fiscal policy. The problem is that once you open that road, as you said, you are testing not only the credibility of your monetary policy, but you're also testing how strong are your institutions. And that's the risk you are facing here. These are extreme and extraordinary times. But these extraordinary times must be walked extremely carefully. And that leads me to my second comment. Right now, we are looking at, in emerging markets, to a complacency risk, because many countries are issuing debt in international capital markets, and many countries in Latin America and other emerging markets think that there is no fiscal problem because you can finance your way out of the crisis in international capital markets. But we know that these things change very quickly, and we know, and we saw during this COVID-19 crisis, that credibility can run out very quickly, and you can have extremely rapid sudden stop in external savings. So, and the final comment I would like to make, and that's, I think, haven't been mentioned, is of the nature of the COVID-19 crisis. We are not facing a typical crisis. This is not a fall in aggregate demand. We have a supply shock related to the lockdown policy, which basically means people cannot go to work. And therefore, if you start throwing money through fiscal policy, fiscal stimuli, you might not have any impact on private investment or private consumption because people cannot work and they don't have means of spending that additional money. And therefore, in that situation where you have a supply shock, you can end up also having restraints on the supply side. and therefore inflationary risk in the medium term. So it's very important to understand the nature of the shock. This is a supply shock that becomes a demand shock. So the typical Keynesian recipe does not work in this environment, both in the fiscal realm, but also in the monetary realm.
Thank you, Lucio. That's actually a great wrap up. I maybe should have asked you to speak last, because that last point is probably where we want to start at the next seminar. Is this a demand shock? Is this a supply shock? Obviously, it's both, but how does one think about the balance and sequencing of those things? I'm going to hand over to, by the way, to the audience who are thinking about whether they want to come next session on that topic. We'll be benching Lucio, and Lucio will let his colleague and friend Federico Sturzenegger know that that is where we want to focus the conversation and take off. Ian, let's hand over to you.
Okay, thank you, Matthew. So I go back to my original point, which is that we're trying to balance up different strategies and the probability of success in the face of extreme uncertainty. And I agree with actually many of the points that have been made, but I would just highlight a few again. The one is that, yes, credibility is a relative concept. And if you look at our numbers, the size of our deficit, and particularly the size of the debt increase over the next 3 years, I would argue we are really at the one end of the distribution of emerging markets. The second point I'd want to make is that QE, it's a pity we couldn't speak about it a bit more, actually, because I do wonder, how, for example, Xavier would think about the impact of QE. Does it actually work to raise CPI inflation and aggregate demand? I think there's a huge question mark there. Although the literature tends to be more clear that QE has worked to stave off a total financial collapse, as could have occurred in 2008-9. But the record of the past 13 years and the fact that it's still going 13 years after the global financial crisis suggests that perhaps it isn't the panacea we'd like it to be. And so then in the end, it comes down to this question about, what are we actually trying to achieve? I think what I'm hearing is that economic theory would tell us we have to go for more stimulus now because of the fact we're in such a large output gap. But, that effectively we're saying we should be spending more as government, but somehow we don't want to pay the market rates on the issuance of that debt. So the Reserve Bank needs to come in, which, as Xavier was pointing out, is slightly different. That's not necessarily QE. That's more about managing the bond yield curve and the implications of the paradigm shift for the Reserve Bank, which I think are significant. So it comes down to, what do we think is the highest chance of working? And if we're going to take risky moves, I wonder why it always comes back to being risky with monetary and fiscal policy and not being riskier with other growth enhancing reforms that we've been talking about for a decade. Where's the boldness and the riskiness on the basics that we still haven't gotten right, like a sale of spectrum and a reform of ESCOM and SAA and so on. So I think part of my frustration is that we seem to keep coming back to the same levers instead of, taking big political or other risks on the other levers of growth. Thanks.
Thank you very much, Ian. Let me just remind the audience that Ian is here on sabbatical. That comes to end in September, I think, Ian, and then he's going to be speaking on behalf of the National Treasury again.
Matthew, sorry, I wanted to add one last thing. Just to say, I went to Lebanon. I wouldn't recommend that we follow in their footsteps. They hadn't had a budget in 3 years when I visited in 2017. So, yeah, I wouldn't recommend it.
Yeah, and There are many good examples out there.
Thought you wanted to avoid doing a budget, Ian. It would make your life a lot easier.
Owen, since you popped up and supersize on the screen with that impressive
yeah,
COVID.
I remember you trying to move us towards a 2-year budget. So I think, okay, my point on Lebanon is clearly missed. I'm sure Ian got it. But my point was that the point when fiscal space runs out, it doesn't look like it's 60% of GDP or 70 or 80. We could push this number much higher if we needed to. It's not a thing we want to do. It's obviously, I agree that the long-term trend is dangerous. And if we have another decade of 0% growth and declining GDP per capita, we are going to have a fiscal crisis, no question. So I think we all agree that there has to be some macroeconomic, or sorry, some structural reforms. We probably disagree on what those need to be. But my point is that in the short term, we still have space and we should use it. It's not desirable to take on more debt, but other things are less desirable, and that's, you know, massive levels of unemployment, hunger, poverty. Those things are worse than having a bit more debt. So rather take on the debt and figure out a long-term plan on how to reduce that debt level when growth returns. Okay, and I think, I mean, this is a story. How did we get in this position is really the key thing. I think there was some fiscal profligacy. Should I use an easier to pronounce word? But the main story has been that we just keep on missing our revenue targets, and we miss our revenue targets because growth has been weak. So we do need to deal with the wage story, but we also need to get growth up. And if we get growth up, our fiscal story will look much, much better. On credibility, I mean, the SARB has credibility. In fact, it spent the last 5 years with real interest rates being too high to build up credibility. At some stage, they need to use that credibility. I mean, the story we've had in the last 5 years where we've been running fiscal deficits of 4 to 5 to 6% of GDP in a demand-constrained economy and getting no growth, to me, that is a clear indication that real interest rates are too high. And at some stage, I don't understand what the point of credibility is if you're not going to use it. All right, so the QE is there. We can use it. It would be crazy not to do it. If we do it, it's going to make our fiscal story look better because we'll have higher growth and we'll have lower interest rates that we need to pay back. So, I do also wish, like Ian, that we had more time to talk about QE, and I think it's an important tool that we should be using. It's a temporary tool, but it's important, and it's part of a package. That package has to include those long-term structural reforms. But just last point, there is no such thing as expansionary consolidation of government expenditure. It does not work. So we are aiming for this big consolidation next year. That cannot work. It will result in a deeper recession. It will result in higher unemployment. It's going to result in higher debt loads. I will just point you to a new paper by, I've lost the authors, but anyway, the paper is called Does Austerity Pay Off? By Benjamin Bjorn, Gunnar Muller, Johannes Pfeiffer. And I'll just ruin the suspense for you. It says just austerity does not pay off. All right, so it pays off when the economy is strong. It does not pay off when the economy is weak. And I think we know that.
Okay.
Next, right?
No, Brian, I want to kind of space the different opinions. So I'm going to ask Mamokete to come in, and then it'll be you.
Okay, so I'm so glad this is the last time I'm speaking on some level. I think maybe my problem is that I'm fundamentally a statistician. So I do lack imagination a little bit. I can only really think in numbers. So I was also looking at the debt levels and saying, oh, well, they're not so high, et cetera, et cetera. But I think when you have debt service cost at 25% of revenue, which is the base case trajectory, I think, for most people in the market, even though Treasury has got a slightly better trajectory. But 25% of revenue means of the revenue that you pick up from, that government can collect, fully a quarter of that goes to debt service costs. What do you do about service delivery? At that point, you're no longer able to satisfy the service delivery commitments that the government has. And that is why at that point, then you need to really question whether the probability of default has not risen dramatically, or some sort of an inability to service some liability or other. And therefore, when people say debt levels are okay, it's not only 60%, that is one thing. But in terms of cash coming in and cash going out, if you're servicing your debt with 25% of your revenue, you're in trouble. So we've all spoken about South Africa's socioeconomic needs, et cetera, et cetera. How are you going to then continue to maintain social stability in that environment? And at that point, your situation is only going to get worse from one year to the next. So there is no doubt in my mind that now in 2020, in August, South Africa is on an unsustainable debt trajectory, and that the chickens are coming home to roost probably sooner rather than later, unless you do something drastically different. So I would like to say, as a point of departure, I do not agree that we're not at a point where we need to respond to a crisis. The next thing is that, incrementally, every day that you don't respond, the policy space, the ability to respond gets narrower and narrower and narrower. And as these things normally unfold, you don't have a liquidity crisis over 5 years. You don't have it. It's not a slow crunch type of event. One moment you're okay, the next day you're not. So the whole situation can turn quite decisively and quite aggressively and quite quickly. And therefore, you don't have the luxury. What you have currently is not that we're going to have a liquidity crisis, but is that the probability that you do have one is high. And you need to lower that probability, because the higher it is, the more uncertain investors become, the higher it becomes. So you need to stop that loop. And the way to do it is not to sit here and be talking about how, well, this is maybe not so bad, whatever. Is to recognize that you're in a crisis and be responsive to it. So for me, I would like to see more responses, and also because once you're already in a crisis, you're now sitting with an even more acute socio-political problem. Your political economy problems become even more challenging. So the sooner you try and be preemptive as opposed to being responsive, what's the word I'm trying to look, reactive, would be my sort of approach to the issue. So, there's a lot I could say, but I think I'd like to leave it there. Rather get ahead of the problem as opposed to behind. It's not to say you're going to have the whole thing blowing up, but the risks are there and they're rising. And the market is telling you that. And QE is not the answer.
Thank you, Mamokete. I see we've come up to 5 o'clock, but I think these are very valuable contributions. So I'm going to keep the comments coming until we end. Hopefully, I won't keep participants or the audience from important obligations. Brian, over to you.
Yes, let me answer Lucio and his interpretation of Keynesian economics. We've had a supply side shock. People are told you can't go to work, you can't do your job, you can't run your business. So then you ease the lockdown. So businesses then have the opportunity to increase output, have the opportunity to increase output, to hire more people to help them do so, and to do what it means when you actually operate normally. However, coming out of a lockdown, any business will be very uncertain about the level of demand. So it's one thing wanting to increase supply because you can. It's another because what kind of demand conditions will you be meeting? And that's where the stimulus comes in. It helps to encourage demand so that supply will follow. So supply leads demand, and demand leads supply. So you need both, and that's where stimulus is required. And more than that, businesses need to have a sense that there is a future for their businesses. They need confidence in the long-term future of their businesses. Therefore, they need confidence to want to raise capital to, in many cases, in many important cases, to actually restock, to fire up again. They need capital. And that's where the bank credit comes in. Bank credit on favorable terms under these schemes, which are not working in South Africa, would help if the businesses felt there was a future of demand out there waiting for them. And that's why you need a champion of those schemes to encourage businesses and their confidence in their future prospects, without which they won't raise output, they won't employ more people. So that's the, you need both. And the more stimulus you get coming out of the lockdown, the more output and the more employment growth you're going to get. And the more output growth you get, the less impact the stimulus will cost you. On the debt service costs, you borrow long in South Africa, you're going to pay a high rate of interest. If you borrow short, you're clearly going to pay less. If you issue less long-term debt, there'll be competition for the long-term debt that's available. So that might help bring down interest rates. So there is a job to fund the increased deficit, which you cannot avoid. You cannot avoid it. You can't raise taxes. And in fact, you have a moral duty to increase spending, to help people over the damage you've caused them. So you borrow short. And the banks become part of the borrowing system. And you do it knowingly and temporarily in a well-organized or well-explained way. That's how you hold down your debt service costs for now. And then you get your fiscal affairs in decent order and people start to believe in your capability of doing so, and then long-term rates come down and the yield curve flattens. And incidentally, there are no market interest rates in the developed world. There is yield curve control, and there will be yield curve control for at least another 2 or 3 years until inflation in the developed world picks up in a sustainable way.
Thank you very much, Brian. That's also an excellent place to kind of pull together your contribution. Xavier, you'll talk last.
Well, thank you very much. I just wanted to have a little quiz with you guys before I go. And the quiz is a quote, and you have to guess the Nobel Prize winner economist who actually formulated that sentence. He said, the chief function of the monetary authorities is the creation of money to meet government deficits and the retirement of money when the government has a surplus.
Keynes?
It's Milton Friedman in 1948.
But Bob would have said it better, though.
and you can then appreciate how much he learned between 1948 and 1969 at the date of the presidential address. But anyway, no, I just wanted to pick up on a few small things, and then the final punchline. I heard something that always hurts my feeling, which is that austerity never pays off. Actually, the austerity does pay off when it is meant to address a deeply structural problem. I think my country is an illustration of that. And since it was mentioned earlier that indeed the interest bill was a huge footprint on the budget, let me just remind you two numbers. In 1990, the Belgian government was paying interest to the tune of 12% of the GDP for a debt level of about 120, 130% of the GDP. Today in 2020, with roughly the same debt ratio, Belgium is going to pay 2% of its GDP in interest. So the space that you earned actually is quite considerable. So austerity does work. Otherwise, we would not have managed to actually do that over the night. And that's a lesson. The second thing I want to mention is that we talked a lot about monetary and fiscal policy and how they should work together, and we certainly agree that they should work together in the context of a crisis like this. And work together means indeed trying to stabilize the economy. And monetary policy can help in two ways. I mean, first, of course, lowering borrowing costs for government. And the second thing is through some kind of guarantee on the nominal value of bonds through what you might want to call QE or yield curve control or that kind of thing. But hang on. I mean, the role here of this QE and of this backstop, I prefer to call it backstop in that case, the monetary backstop of the debt, is really to rule out an expectation or belief-driven bad equilibrium on markets. You don't want markets to be in the driver's seat and cause a crisis that should not happen. So if you're fundamentally solvent, then indeed the central bank should intervene, stabilize markets, even be the market, to rule out these bad equilibria. However, you should not abuse that, because if you are facing a fundamental crisis that indeed solvency is an issue, then the central bank should stay out of it. So in practice, it's quite difficult to see the difference. And this is why I think history is littered with examples of accidents where those fringe policies actually could not be reversed on time. We discussed the case of Argentina not too long ago. And by the way, when you want to think about ways in which the Treasury and the central bank should coordinate, I'm even prepared to argue that the kind of crisis we are going through could be a case where they should actively coordinate, including through YCC. However, you need to wire this into the system. You need to make sure that there is a clear exit from this situation, which has to remain exceptional. I mean, everybody who made that point, with which I'm ready to agree, actually said, oh, well, and when it's over, we can just go back as usual and exit this kind of, extreme or I would say fringe policies. And I think the secret is in the exit. If you don't wire this kind of exceptional coordination between Treasury and the central bank, then this is a regime change. And I'm not sure that in the face of regime change, inflation expectations and other expectations in general will remain that well anchored. And I should like to remind you that the entire literature, at least the one I'm aware of, maybe there are authors I haven't yet discovered, but most of the classic authors that wrote about the policy mix are very clear about the fact that, yes, you have two instruments, money and fiscal, and you should keep them in separate hands, a treasury independent from central bank and vice versa. Or central bank independent from treasury, it's probably a better way to put it. Thank you.
Thank you very much. I can see we're starting to lose attendees, but we've got a hardcore 42 remaining. So let me wrap it up with a couple of observations and some thanks from my side. Just to take us back to where we started, both Xavier and Brian were talking about the financing gap between savings and the financing challenge we face, and how we go about addressing that over a medium term. We've introduced on top of that the idea of fiscal consolidation and how that macroeconomically works out. And Xavier had mentioned the role of DFIs, the IMF, in terms of a bridging role. We haven't discussed that at all. We've gone straight to QE. And I wonder if there's something indicative about that. But my second and related comment is, budgets, in my experience, could be wrong, but budgets always do seem to balance ex post. They balance either through real economic growth, which swells your tax base and becomes your and your set of expenditure becomes more affordable, or you reduce your budgets by cutting spending, or you use inflation to erode the purchasing power of the budget itself, so it buys less real goods while simultaneously swelling the nominal value of your tax take. And how we think about those options in an environment where we're highly reliant on private sector and, in fact, global financing, and the credibility of our institutional frameworks as a means for accessing that financing is, I think, going to define a significant part of what kind of economic success we can create. I would like to highlight very, very strongly that in this conversation, as well as the previous conversation, the credibility of growth as an alternative to aggressive fiscal consolidation is something that is coming up over and over again, and we still have yet to see what the structural program of reform that will improve the competitiveness and the productivity of this economy is likely to be. With that said, I want to say thank you very much to the panel. Each of you has made very relevant and very important contributions, and I think have enriched the landscape of this debate, and I'm very grateful for the opportunity to have to have administered that. Also, there's another research fellow that works with me in doing a lot of the research behind these, Biniam Basso, and just to thank him for the work that he does in putting together the background research for these sessions. Lastly, let me thank the audience. Again, fantastic contributions. I believe those are public. You're all able to see them, and they therefore contribute to the overall learning of these sessions. We will again look to put some of those questions and comments out on LinkedIn for the community of people to make observations and comments with. We tried that last week. It didn't really take off, perhaps because people didn't know we were doing it. But if you are wanting to contribute to this conversation in between our sessions, please have a look at the ERSA LinkedIn profile, and we will be putting out questions for your comment and contributions over the next couple of days. With that, my last thanks would be to Margot, and Margot, over to you.
Thank you, Matthew. And I think in addition to having a really amazing panel and great questions from our audience, you summed it up really well. Today's conversation has been incredibly insightful and informative. I can only say an additional big thank you to you for all your facilitation and working with everyone to make it happen too. And you have also dropped some teasers for the next one, which is taking place on the 26th of August, and that will be about the budget and the post-corona economic recovery. So we look forward to seeing you then. All updates will be on our social media channels, and we will send our invites out in the next few days, definitely within the next week or so. We look forward to seeing you there, and thank you everybody. It's really been an amazing afternoon.
Thanks everyone.